All right, today we're jumping into a massive shift happening in the media world. Reality TV, the thing that's been a cash cow for decades, well, it's collapsing. And hidden inside all that chaos is a really powerful investment strategy that proves the old saying, content is king, is officially dead.
So let's get straight to the point. This is the core idea right here. Forget about just buying stock in Disney or Warner Brothers. We're going to follow the smart money, and it's looking at something way more specific in all this financial mess, the distressed debt of the production companies that are just trying to survive this huge transition.
Okay, to really get this opportunity, we have to connect the dots. We'll kick things off with the content collapse itself, then get into the debt crisis that's really causing it. After that, we'll look at the new media machine rising from the ashes, break down the actual investment strategy, and finally, wrap it all up with the actionable thesis.
So let's start with how things used to be. For decades, the whole TV industry was built on one simple, very profitable idea. Content is king. And you know what the most profitable, most reliable piece of that kingdom was? Unscripted content. Or, as we all know it, reality TV.
I mean, think about it like this. A single episode of some big-budget drama can cost millions. For that exact same price, a network could make an entire season of a reality show. It was a no-brainer. Super high margins, super low risk. It was cheap to produce, easy to sell ads against, and incredibly profitable. This was the foundation of their whole business model.
But that golden goose is in a terminal nosedive. The data is just stark. A jaw-dropping 31% drop in new unscripted show orders for the next season. Now, this isn't just some small dip or a bad year. No, this is a signal of a massive structural collapse in how this kind of content is funded and made.
And look, this isn't some abstract trend. Let's look at the channels you actually know. HTV, a powerhouse in unscripted TV, has cut its number of shows by more than half, from 78 shows down to a planned 35. The Food Network, seeing a pretty similar collapse. They're being forced to just abandon their old playbook of flooding the airways with content because the financial model that supported it all, it's broken.
So you have to ask, why is this happening? Well, the content collapse, that's just the symptom. The real disease is a full-on balance sheet crisis right at the heart of legacy media. They can't even afford to make these cheap shows anymore for one very simple reason. They are absolutely drowning in debt.
For years, the name of the game was get bigger no matter the cost. These media giants borrowed billions and billions from massive mergers. But, that party is so over. Now, for a company like Warner Bros. Discovery, the number one thing on their mind isn't making the next hit show, it's pure survival. Their entire strategy is now run by one simple phrase: balance sheet repair.
And this is what that repair process, that deleveraging, looks like in the real world. After its huge merger, Warner Bros. Was stuck with over $52 billion in debt. They've had to aggressively pay that down, shedding billions every single quarter just to keep their heads above water. This is a company in survival mode, not growth mode. And here's the really brutal part of their situation. Even when a company like Warner Bros. Discovery actually makes some cash, it's not going towards new shows. Nope. Every single dollar they have has to be used to service that massive debt. This is what's starving the content machine. The money just isn't there anymore. Okay, this brings us to a kind of technical but super important concept for this whole investment idea: compressed maturities. Let me break it down. Imagine if your mortgage, your car payment, and all your credit card bills were all due next month. That's what's happening to them. A huge chunk of their debt is coming due in a really short period of time, which forces them to refinance at today's much higher interest rates. This puts an even tighter squeeze on their cash, and that pressure creates shockwaves all the way down to the small production companies that rely on them.
And the direct result of all that financial pressure? A wave of bankruptcies. We're seeing a massive shakeout in the production community. Companies like Gum Studios, which is a major production facility, and streaming companies like Chicken Soup for the Soul, they're going under. But the most telling one might be QVC Group, a cable TV staple, filing for Chapter 11 to handle its $6.6 billion debt load. The old guard is just crumbling.
But, out of the wreckage of this old world, a new hyper-efficient model is popping up. And this isn't just about swapping TV for YouTube. No, it's a fundamental change in media economics, led by what we can call the new media machine.
This side-by-side really shows you just how outmatched the old model is. A traditional HGTV show takes 6 to 12 months to make and relies on old, delayed data.
A top creator like Mr. Beast, he can turn around content in days, reach a global audience of hundreds of millions, and get real-time, minute-by-minute feedback on what's working. It's a battle between a dinosaur and a mammal, and we know who wins that one.
And this new machine isn't just faster, it's fundamentally smarter. Mr. Beast's philosophy of creativity saves money is just a masterclass in efficiency. I mean, why give away 20 grand in cash when a year's supply of Doritos, which only costs about $1,800, is funnier, more memorable, and better for the video? That's a 91% cost reduction with higher engagement. That is a level of data-driven operational excellence that these bloated old studios, they just can't compete with.
And this all creates a paradox that kind of tells the whole story. Even as HGTV is slashing its home renovation shows, the real-world demand for that exact same information is at an all-time high. A garage door replacement can deliver a massive return on your investment, but people aren't waiting for an hour-long TV show anymore. They're getting the answer they need from a 10-minute DIY video on YouTube.
So this brings us to the big question. How does an investor actually play this? How do you capitalize on this massive transfer of power? Well, this is where we find the alpha, the real edge, in what's known as media credit arbitrage.
Now, this strategy is not about trying to guess the next big YouTube star. That's a gambler's game. Instead, it's a very disciplined three-step process. First, you separate a creator's predictable cash flows like ad revenue from their creative side. Second, you do a ton of due diligence to value their IP as a real bankable asset. And third, and this is the most important part, you invest in the picks and shovels, the underlying technology that powers the whole ecosystem.
The smart money is already making these moves. Private equity is pouring billions, not into individual creators, but into these toll booth companies. Think about firms like Synthesia or 11 Labs, which provide the AI tools for video and audio. They are the new infrastructure. The bet is simple. Instead of trying to guess which car will win the race, just own the road that every car has to drive on.
Okay, let's pull all of these threads together. This is the actionable takeaway from everything we've just covered.
In this new media world, there is no middle ground. The old way of just producing a ton of good enough content is dead. The new standard, driven by data and efficiency, is A players or death. Mediocrity is poisonous. Only the absolute best performing, most efficient, data-driven creators are going to capture the value. Everybody else is going to be left behind.
So this brings the entire strategy into focus. You're betting against the stock of the bloated legacy companies while you look for value in the debt of the production houses that are being forced to restructure. At the exact same time, you're investing in that picks and shovels infrastructure and lending directly to the top-tier creators. It's a complete strategy that profits from both the decay of the old system and the rise of the new one.
And that leaves us with one final big thought. For decades, the saying was content is king. But if the people who make that content are now totally dependent on the underlying platforms, the data tools, and the AI software to make and distribute it, have we entered a new era? Is the real power and the future profit no longer in the content itself, but in owning the infrastructure that commands our attention?